the mishaps there, but now we're connected and ready to go. So I'm going to share my presentation. So you should be looking at and hopefully see the disclaimer there, which is the material in this presentation has been prepared by Social Security, by the Public Affairs Office, intended for educational purposes only. So just keep that in mind. We are looking at 2022, today being the 19th of January. So everything is for this date. Everything is current as of this date. So in the future, if you pull this back up, whether you're looking at slides or some of the information, just keep in mind the best information as we go through, and you'll see in the presentation, is gonna be going back to our website. So let's go through that and there. So our website is to me, the best place that an individual can start. Um, it's where you should be looking for information. Oftentimes, we get a lot of individuals that will contact Social Security, and when they do, they're looking at um, information that is, they're asking questions without looking at the website, and so they're asking very basic questions, almost I'm going to say almost wasting your time because of the amount of time it may take to get to speak to a representative. And if that's the case, then um, you could have maybe developed a better question and answered your own initial basic questions by going onto our website. So I would always encourage everybody, start at our website, get the information that you have there, and that'll help you build a better question as you move forward. Now, our retirement section is built into, and what we did, we separated into three areas as you see there: learn, apply, and manage. Learn is basically that's for the portion that you are looking at um, prior to receiving benefits, prior to applying, where you're gathering information, making sure that this is and date wise when you want to start, how much you're going to be eligible to, how the program works. All of those types of questions would be under the learn, and so there's links there that will take you to that section. Whereas the apply is, I'm ready to start, I have my date, I'm ready to go, and there's a 3-month system limitation. So within 3 months from the date you wanted to start, that would be when you should hit and apply online. And then manage is anything that is post entitlement. You've already started receiving your benefits. And so now the questions are, what if this occurs? Or what should my spouse be aware of? Or what if I need to change information? How do I update my address or my direct deposit or whatever it may be? So that would be in that section there. So everything through the retirement benefits window, as you go into that page, will really provide you at least some direction when it comes to retirement. The other is the My Social Security account. When you set up a My Social Security account, what you're doing is you're gaining access to your own information. So I would strongly urge and request everyone, please set up that account. This is where you are looking at your own information. It's gathering the information or pulling it right from your record. So you're looking at the most current information that we would have. You're able to take a look at. And one of the design changes that we had, and you might remember those old statements that had the green print, and it was kind of difficult to figure out what they were, what the information was really trying to tell you. It was kind of convoluted, if you will. And so as you see there, what we've done is we've broken it out into each of the different program areas of what you might be trying to inquire about, whether it be retirement, disability, survivors. If you're looking at your statement as far as the earnings record and what that really does and why that is important. So I really like the new design. It's very clean, it's very easy to understand. And so you can access that through your My Social Security account as well as verifying other things on your record. And so I would strongly encourage everybody to do so. So let's move into what you're really hearing, which is to learn about Social Security and what we have available for you as far as just upping your knowledge level so that you're comfortable in moving forward with your retirement plans. And so let me start with the very basics just to make sure that everybody, and there may be some that maybe have never heard and might be confused. So I'll clarify a few myths even just by doing this. So the first things first here is In order to be eligible to a Social Security benefit, the individual has to have 40 credits. So how do you get those credits? By working and paying into Social Security tax, you will develop a credit. This year, for every $1,510 that you earn and pay Social Security tax on, you would receive one credit. There is a maximum of 4 credits in a year. So after $6,040 for 2022, you would have hit your limit of how many credits you can earn. But credits are a moot point if you've already reached your 40 credits. As once you hit that, which is equivalent to about 10 years worth of work, most people early on in their career are going to hit that. And so let me go back up and show you. If you look at your statement and you see a dollar amount, then that's already notifying you that you have already attained your 40 credits, and now 40 credits is moot. We don't have to worry about it. No longer any discussions. There's nothing to worry about when it comes to credits. The only thing that would then go into is the next step, which is, well, how much am I going to receive? And when we determine how much your benefit is going to be, there's a few steps we take into the process of this overall calculation that we have to run it through. So the first steps that we do is we take every work that you've ever recorded that you've paid into Social Security. We're going to take that and index it. So once it's indexed for inflation, we then go to the second step, which is to determine which are the highest 35 years that you have ever paid into Social Security. After we have those highest 35 years, we then say, all right, we're going to take that and determine a monthly earning amount. So that average index monthly earnings, or an AMI as we call it. We then turn around and into the second part of the process is we run it through this calculation. And so in this example with the 6,500 AMI, or average index monthly earnings, we're going to take it, and as we push it through, we call them bend points, BEND. So if you're looking up information in regards to this calculation in our system, you would be looking up bend points. And so the bend points change each year according to the COLA, according to the economy. These will fluctuate. They normally always are going to go up. And so what that really means is that your work that you've done, you're receiving more, because the first bend point, the first 1,024 for 2022 of your average that we utilize, those highest 35 years, the first 1,024, you're going to get 90%. But you can see the bulk of what you receive is in the second bend point, which is 32% of the 1,024 up to 6,172 of your average. And for anything above that 6172, the individual gets 15%. So we raise the bottom, and that's that 90%, which is the anti-poverty portion of Social Security. Then we suppress the top and bring it down, and that's to create this band or average. And what we say is, when we look at your benefits, and in this case it comes out to 2617, that's called your primary insured amount. That's the benefit that you would be eligible at full retirement age. So I'm going to kind of go back here. So when you look at, and it says your full retirement benefit age is estimated at, what we're saying is that's your primary insured amount. Everything is going to drive off of that. So as long as your earnings record, and you reviewed it and you make sure it's all correct, that there's no zeros in there, because when we're using the numbers to determine if what your highest 35 are, individuals often think, well, in the 1980s, when I was starting my career, I made less. I was only at 25, or I was at 30,000, but now it's much higher. So I imagine be fine. There may be a zero in there that, because of the multipliers, those may be part of that high 35. And so I would really encourage you, review your earnings record, make sure that it's correct, so that when we are calculating, we're also giving you the correct amount that you're eligible to, so that when we look at this calculation, we go through the different bend points, it comes out the correct amount. Now, if an individual has not worked 35 years, say they only worked 30 years because they were able to retire early through their program, or you all through the county, well, then there's going to be 5 years of zeros. And those zeros are going to drive the average down, which then is going to impact the final number here and will decrease your benefit amount. So just keep that in mind. So although it is nice if you're able to retire early, maybe, and what some people may do is they continue to work maybe part-time just so that they're replacing a zero with a number. So even if you continue working after you start receiving your benefits, we're still going to utilize those numbers in order to recalculate whatever you have paid into. And so it would replace a zero, therefore increasing your benefit amount, albeit a minimal amount. Don't, because it's 1/35th, it's replacing a zero, but it's only 1/35th prior to the calculation, and probably what you're going to impact is the 15% on that side, raising that up. So it's going to be minimal, but it may be something. It may be 20, maybe 30, $15, whatever it may be additional per month. But at the end result, in a year, you're talking, that could be $1,000. It could be $2,000. So you definitely want to make sure that what your goal would maybe be is having those 35 years that you've paid into, even if after you do your primary career work, even if it's some type of part-time or some other type of work. So what can you do once you know what you're eligible to receive? So you know what your primary insured amount, your full retirement age amount is. What are your options and strategies? How would you go about utilizing that? So let's look at this. The first and point we need to start is the earliest age. The earliest age at which you can receive a benefit is 62. But as it states there, although the earliest age is 62, there is permanent reduction. Now, there's two things I want to talk about. So the first is listed there as it states, you can have permanent reduction, and that reduction is dependent on how early you're taking it as opposed to your full retirement age. So meaning this, if you take a look at the year of your birth, so find whatever year you were born in there, then go to the middle column, the full retirement age column. And in that column, what you're going to see is your full retirement age, or FRA, as we call it, FRA. That is going to determine at what point your benefit matures or becomes complete, right? So that is at age 66, or in a couple months or a few months, depending on the year of birth. If you take it at 62, there's going to be some type of reduction. Now, in the chart here, it shows that at 66, the reduction is 25% at age 62, then moving to 30% at 67, because 62 remains constant. So it went from 66 to 67. So therefore, the reduction is going to be greater. And that's all that that's saying. But let me give you a better number, and that's a 0.5%. It's 0.5% for each month early that you take your benefits. So if you take your benefits 40 months early, let's say, then your reduction is going to be 20%, right? 0.5% per each month. You take it 30 months early, 0.5% will give you a 15% reduction, ballpark figure. So that way you can determine, okay, well, I want to take it about 15 months early, so at about a 7.5% reduction off of my 2,000 to make it easy in our minds. So I know I'm going to have roughly about $150 reduced off of it, or $10, whatever that reduction is, dependent on that percentage off of your primary insured amount. Remember, your full retirement age amount. Everything drives off of that. So you have reduction. But I told you there's two things that are going to impact you, and we've only looked at one. So let's look at the second, and that is that there's an earnings limit. So if you stop working and you start receiving your benefits prior to full retirement age, that's fine. And you can still work. As I stated, you may even just do part-time, but the limit can only be 19,560 for this year. Each year it does change, and so you'll have to take a look at that. And when we say work, we're looking at gross wages, W-2, or net earnings from self-employment. So maybe you have a business you're going to start as you retire from the county. Well, that's great. Excellent. But just keep in mind, your net earnings will count against if you started your benefits towards that limit, towards that limit of $19,560. So just keep that in mind. Now, the year of your full retirement age there, the 51,960, what we're talking about there, and I'll briefly touch on it. You'll have to read up on it more because it gets a little involved here. But it basically is saying if you go from January to the month prior to when you hit your full retirement age. So let's say this year, 66 and 4 months, you're going to hit that in July. So now we're looking at January through June. Are you above the $51,960? If you're not, then you could plan on starting in January this month rather than waiting till July, because in July, what happens when you hit your full retirement age, there is no income limit. Now, if you waited at that point, you get 100% of your benefit. So you wait to July, you get 100% of your benefit, no income limit, and you could continue working. Or if you're going to be below that 51,960, you could say, you know what, I'll start it now. 6 months is only 3% off of, again, just use a round number, 2,000. So you know that you're only going to have about $60 plus or minus that's going to be reduced off of it, but you're getting 2,000 in hand or 1,940 in hand. The amount that months that it's going to take, time wise, for you to make up that difference is going to be, you're going to be well into your 80s. So that the question then becomes, would it be better for me to start at the start of the year in January if I'm below that, knowing that my full retirement age is going to hit in the middle of the year somewhere, or at least below the limit? Then that's what that would do. And that's how you would use that as far as a strategy. But do keep in mind, if you start your benefits in the reduced, when we get to spouses, I do want to touch a point there, which means your spouse would be reduced in the amount that your spouse would be able to be eligible if you predecease your spouse. So we'll talk about that when we get there. Going back to full retirement age, 100% of your benefit, you can continue working. The question that usually comes up here is, will not have taxes? Will it affect? Of course it will. It's income. You're going to have to count it. Now, there is, with Social Security, you can read on how that impacts. It's only 80% of your benefits amount is counted in, and it breaks down even further. So I would say read on that section, and that'll help you understand it a little bit better. Now, if you wait until age 70, which is the other option here, or past your full retirement age, for every 12 months that you go past your full retirement age, you're going to increase your benefit by 8%. So that's a great investment into yourself if you do the delayed retirement credit. If you go from 66 to 70, that would have been 4 years, 4 times 12, or 4 times 8, the 32%. If you're going to 60, let's say 67 is your full retirement age, and you're going to hold off to age 70, say you're going to continue working. Maybe you're like me, you love what you're doing. It's a fantastic job. I mean, it's a job of your dreams, and why would you ever stop working? And so you're going to continue working. So you just wait to take it up to age 70. You increase from 67 to 70, 3 times 8, 24%. And then really in a period of time where you're not going to increase your income too much, it's a great way to do so. So 8% for every 12 months. And we actually go month to month reduction or reduction that you saw there, as well as delayed credit. So if you wait only 15 months, you're going to get 15 months worth of, or 20 months. And it works out to be about 0.66% of increase per each month that you delay it. So as a quick summary, you can either take it early prior to your full retirement age, as early as age 62, but you're going to have reduction, as well as there's an earnings limit, and you'll need to check each year to see what that limit is. Or you're going to take at full retirement age, you get 100% of your benefit, no income limit from the point you hit your full retirement age moving forward, so you can continue working. Or you don't need the Social Security benefit, you want it to increase in value, so you're going to wait and have it delayed. Just remember, age 70 is the maximum. You never want to go past 70 or you're throwing money away. So make sure that if you're going to delay, write it up somewhere. I jokingly say, paint it on your wall, file for benefits at age 70, whatever it's going to do to help you remember, but make sure that you do it no later than 70 or you will lose money. Now, we talked a little bit, or I mentioned spouse benefits. So there is, and this gets confusing for people because there was a new law that was created in 2015, and it states that a spouse is eligible to receive on that record, on the number holder's record, but they have to take, in what we call deemed filers, they have to take their own benefits on their own record prior to what they're eligible on a spouse record. So in a life claim, a spouse is eligible to 50%. So let's say that the number holder is eligible to $2,000. So the spouse is eligible to $1,000. But if on their own record, that spouse is eligible to 1,500, well, the 1,500 is greater than what they're eligible on the spouse record. So in a life claim, never going to receive benefits there. But as soon as it becomes a death claim or a survivor benefit, if the number holder predeceases, then that spouse is going to be eligible to 100% of the benefit. But now here it comes in. If that individual, the number holder, had taken even 1 month early on their benefits, then you can see there is this reduction. It can go down to, it will go down to 82.5% of whatever that PIA or that benefit amount is eligible. The spouse is going to be reduced down to 82.5% of that. So if you're the primary wage earner and you you look at and most the chances are if you think that you're going to predecease your spouse, then you probably don't want to take it early if you are trying to set up your spouse in the best scenario and you love your spouse. If you don't really love your spouse and you become bitter in the years, then just take it early and they're going to be reduced. Just kidding. Whatever, plan that out. Now what I do want to say when it comes to spouses and to benefits, please be careful with this in the sense of plan for it, because when an individual takes the benefit, and so you have a couple, and the spouses, maybe one gets 2,000, another takes 1,500. Together they're receiving 3,500. But as soon as one predeceases the other, the spouse can jump up, the surviving spouse can jump up to the higher benefit. So in this case, in our example, 2,000, but the 1,500 is going to go away. So now instead of the 20, the 2,000 and the 1,500, 3,500 in the budget, that surviving spouse is now going to go down to 2,000. And so now there's a gap in the budget. Just plan for that as you look at that and say, okay, we expect and know that one is going to predecease the other. So only the higher paying Social Security benefit is going to remain in survivors if that's the case, or on that own individual's record. And so as long as you're making and planning for that, then that's exactly it. You're planning for that. Now, divorced spouses are also eligible on the record as long as their marriage had lasted 10 years prior to them receiving their divorce, and they have to be unmarried at the time as well. The number holder only has to be age 62, does not have to start their benefits for the individual to be eligible on that record, whereas a current wife would have to wait until the number holder is receiving their benefit, which is probably the only difference. Now, all work as far as income, still the same. You have to be below those income levels. If you start prior to full retirement age, you're going to have a decrease. You're going to have that permanent reduction. But as I said, while while the number holder is still alive, there is no delayed retirement credit. So you don't go above the 50% or of that full retirement age or primary insured amount. So that's always going to be the maximum that an individual can receive as a spouse benefit. And again, if you look at this, it's 50% while the individual is alive, and then it jumps up to 100% if the spouse, that number holder, predeceases the spouse. It's in both. I've seen cases where both the current spouse and the divorced spouse are receiving on the same record, um, and it doesn't interfere with either. Just keep in mind for either one, the deemed filing says you have to take your own benefits first. And so if your benefit amount, your full retirement age amount, is higher than 50% of the number holders, if the number holder is alive, then there is nothing. If you're looking at survivors, that's a whole different type of decision to make, because if the number holder has already predeceased and you have not started any benefits, you have the option. Do I take the survivor benefit, allow mine to grow in higher in value, or I jump on mine, allowing the survivor benefit to grow to its highest value, which would be at the number holders or at the person's full retirement age. So whenever the surviving spouse wants to receive that benefit, it would be at full retirement age. Hopefully that you kind of caught how that works. It can get a little convoluted between a living number holder and a deceased number holder. So when you're talking survivor benefits versus the ongoing auxiliary spouse benefit. So just read up on that, the difference. But the main difference is, while the number holder's alive, it's 50%. Once they have predeceased the spouse, it's 100%. And you have to meet all the other requirements. And then for a survivor benefit, you're just not worrying about your own record. If you don't want to take that, you can take just the survivor. Now, as I wrap up, and as you can see, there's not a whole lot in the retirement. We can go back and answer some of the questions. I want to leave ample time to do so. So I'm going to just run through Medicare, which is very important when you're talking retirement planning. Now, Medicare and Social Security are two separate agencies. Now, the people get confused because when you're ready to file for Medicare, where do you go? You go to Social Security. So Social Security handles the application for and managing the ongoing benefit, meaning that you're paying the monthly premium in order to have the Medicare. It's done through Social Security, but everything else is Medicare. And Medicare can become confusing. So I highlighted on there, if you were to go to their webpage, medicare.gov, and scroll to the bottom, you'll see that what Medicare covers. If you click on it, it'll take you to all that information. It's a great page to go to. I go to it often just to make sure I understand what the coverages are, because there is kind of a couple different paths you can take. One is you take your Part A and B of Medicare, and then you supplement it with something else. Or you do the Medicare Advantage plans, or MAPs as they're called, formerly Part C, and you go through and you take whatever provider has offered, whichever you select, and you choose their plan, and it's all encompassing. It's the benefits, the access to their whole group, including those will include, or most of them, I don't think there's any that don't, that include the prescription portion, but you have to stay within that program. So the original Medicare gives you some flexibility, where the Medicare Advantage plans, the MAPs, lock you into a group, but the MAPs are generally less expensive. There's usually no out-of-pocket cost as far as for the premium outside of the Medicare. Then you just pay for, once you're using the service, now you have the out-of-pocket for, um, whatever costs they may have internally. And so you'll want to take a look at both of those options and choose which is best for you. Now, how do you do that? There are groups, and within the state of California, as you see all the counties broken up there, for Medicare, it is broken out to, your plans are broken out by the county. So if you move from one county to another, chances are you're going to have to select a different Medicare provider. You're going to have to change your plan. And so if you're doing so, to help you understand, there is the Health Insurance Counseling and Advocacy Program, which is through Medicare. They give grant monies to the state, and then the state has sent those monies to the counties. And here in San Diego, they have outsourced to Elder Law Advocacy, and this would be the group that would help you at no cost to you. It's a not-for-profit group. They're able to help you, and all they're going to give you is straight information. They're not going to push you into anything. They're not trying to sell anything. They're just there to help you, because Medicare on a national level can't try to figure out every state and every county and every plan, but they leave that up to the states to determine. And so this would be the group for San Diego. If you're going to another county, they can give you and connect you with whatever group oversees this program in that county. Or if you're moving out of state, once again, you can pull up that information through the Medicare website and then take a look and say, okay, in this state, who is the provider for that advocacy? And I would strongly suggest that you do that. Now, coming back to the Social Security side, when we look at Medicare, there's three enrollment periods: initial, special, as well as general. Now, the general enrollment means you kind of made a mistake, or you're trying not to maybe have some extra cost and you didn't take it. but there's penalties, meaning you're only going to be able to enroll during that January 1st through March 31st, and it's not effective till July, and you may have an additional percentage, 10%, for each year that you didn't take it post age 65 when you should have taken it. So I'm not going to talk more about it other than you'll have some restrictions and penalties there. Coming to the next two, or looking at the next two that you do need to be aware of, is initial and special. Initial says at age 65, when you're eligible to Medicare, you're going to have 3 months before and 3 months after. So a 7-month window that you can take and enroll into Medicare. But the month that you enroll is going to also indicate when the coverage starts, that effective date. So if you enroll into Medicare by contacting Social Security and filing for that benefit, whether it be online or you do it over the phone with us, however it's done, the first 3 months, if you do that, then your Medicare will start the month you hit age 65. Now we don't go by birthday, so if your birthday's on the 15th, it doesn't mean that you get Medicare from the 15th through the rest of the month. It's the entire month that you turn 65 that you're eligible to Medicare. So if you enroll the months prior, month 1 through 3 prior, then the month you hit 65, you're entitled to Medicare for that entire month. But if you hold off and you procrastinate or don't do what you need to, and you come in the month of age 65, it's going to be delayed by one. Or if you come in 1 month after, it's 2 months. And as you see 2 or 3 months subsequently, then it's 3 months later that you're going to have to be delayed. So please try to avoid that because it could affect and heavily affect you on cost and other things. So you want to make sure that you're coming in 1 to 3 months before age 65. So right at age 65, it's created, and that would be for the initial enrollment period. But if you're going to continue working and you have coverage through a current employer, then you do not have to file for Medicare at that time. You'll be under what's called special enrollment. Special enrollment says you're going to have 8 months from the month you terminate. Now, when we say current employer, that has to be you or your spouse has a medical coverage program through their current employer. It can't be some type of handshake. They'll cover you for the next 5 years and you separate from the company. No, it has to be your current employer and that you have coverage through them. As long as you do, you do not need to take Medicare at age 65. You would just wait until you terminate, and then at that point, you're filing for Medicare. When you do the special enrollment, Medicare is effective the month following that you enroll. So if you know you're going to stop working in July and you want that Medicare to start in July, then you would contact Social Security in June or file online in June. And then in July, it would be effective the month following. So just make sure that you understand that you do have that special enrollment. You don't need to take Medicare if through your current employer you have coverage. That'd be a waste. It's not going to cover anything different. It's going to be a secondary that would never be used. And so you'd be wasting money by paying the Part B premium. So when we talk about Part B premium, the Part A and B, Part A is at no cost if you've paid into the Medicare system. It's Part B that you would pay a monthly, and currently right now it's at 170 and 10 cents. Now, if you see this chart here, what this is saying is that if your income is higher than these brackets, you're going to have this additional amount that you pay for the month, the Part B premium. But what this does is the way that Medicare sets it up, they're looking at 2 years previous. So for 2022, we're actually using income from 2020. So that might have been where you were still working, both you and your spouse, and you were maybe up in the 200,000s together jointly that you filed your IRS tax filing. And so in 2022, when you stop working and you file for Medicare, we're going to say, well, you were at 200,000, so you're going to have this additional amount. Well, that's not the case for this year. Your income for this year is decreased. So there is a form, an SSA 44, which is a life-changing event form for the income-related monthly adjustment amount. What we're looking at here, if you get that notice, and that is the case where 2 years previous you were both working or you had a higher income, and then the year that you're filing for Medicare is less, then you can estimate that by using that form SSA 44, life-changing event form. You file it with the Social Security office as soon as you get that notice. Don't delay. As soon as you get that notice that says you're going to pay extra, if you feel you don't, get that form, complete it, send it in so that we can look at, and if we receive that waiver, we'll decrease and return you back to whatever bracket or with no additional charge and just the 170.10 again for 2022 is the amount. And they do tend to increase, so you're just going to have to keep an eye on that and what that would be. Now, when you're ready to apply, best way is online. You can call the 1-800 number to make an appointment and take it over the phone, and we'll take your application over the phone or at our office. But currently, right now, what we're stating during COVID is in trying to keep the public safe, our offices are not open to walk-in traffic. So in order to get an appointment, you would have to call. So the best way is definitely going online, file it. If you have questions, you can always talk to one of the representatives in your local office. Or if you want to call the 1-800 number, you can make an appointment. We'll take your application over the phone. You can ask those questions at that time. If you meet the critical need evaluation, you may be able to have an appointment in the office, but we're only doing it for critical need right now. So just keep in mind that if you're going to visit an office, you have to have that appointment. So it has to be by critical need approved through the local office. You're going to have to obviously wear your mask, and we're keeping the number down. So it means that you may have to wait for your appointment outside. Again, in this area, San Diego, we don't really suffer with too much bad weather. We're not like the East and the Midwest that's getting pounded currently, but that's how that works. So just thank you for your patience in regard. I know that if you're trying to call on the phone, it takes a little bit longer now in these days, but we will get to you. Now, what I offer for all of those that are here, and I appreciate you taking the time to be on this webinar. And so what I offer is you have the Q&A that we'll go into now, and we'll try to answer as many of those questions. But if you go on to the website and you're unable to get the answer that you need, maybe your situation is a little bit more complex, then I would say, feel free to reach out to me. Now I'm going to change my name on here. So when you see what you see as far as my name is going to be my email address. And I have no problem with you emailing me if you've already looked at the website and you determine that this is, it doesn't answer all your questions, you still have some, feel free to reach out to me. I'll try to answer that best I can, whether that's a link or some further information online, or if we need to set up a time to talk, because I know that it can be complicated to try to get through to someone in the offices. And if I can help, then definitely. When we did these in person, I would stick around and we could chat. So we have limited time now. So if we'd like, let's go ahead and move into the Q&A portion. And I'm not sure who's going to monitor that. And if you want to ask me the questions, and then I'll answer them, if that works.
Yeah, Jeffrey, thank you so much for the information. And thank you so much for providing your email. That is mighty generous. So we did get a lot of questions that came in. I'm going to work backwards here, starting with the most recent. So can you explain the windfall elimination provision?
Yeah, so the windfall elimination provision is for individuals that have a pension where they paid into that pension and not Social Security. Now, from what I understand, the county, you pay into both. You pay into Social Security and you're paying into your pension program. So you will not fall under this windfall elimination provision. That's not going to affect you. But maybe there's someone that maybe worked at a CalPERS where they did not pay into Social Security, or a CalSTRS, maybe they're a teacher, whatever it may be, then they would have the windfall elimination provision, which in it's the most basic way to explain it, in that first bend point where an individual gets 90%, instead of 90%, they get 40%. So it's just a reduction of the first portion, which right now, is that 400 and some dollars. That would be the difference that the individual would be decreased by. But if your spouse, let's say that maybe your spouse is a teacher and they're going to have this windfall, it doesn't affect you. That's on their record only, not on yours. So hopefully that kind of explains windfall elimination provision. If you have another question on it, I would say go to our website, read on it, and if you still have a question, then feel free to shoot me an email and we can chat about it.
All right, thank you. And then we have another question here about disability. So disability through Social Security, how does that apply to age maximums? If you could just speak kind of generally to that.
Yeah, disability is if you're found to have a disability, an incapacity that keeps you from working in any shape or form. So we know that people work through disabilities. But if you're found to have a disability, you're going to receive the primary insured amount. You're going to receive the full retirement age amount. That's what your benefit would be. So whatever is on your record, you receive as if you were full retirement age. And then you're eligible to that benefit. You're after 2 years of a disability, you're also eligible to Medicare, as well as any minor children, children under the age of 18, would be eligible to a beneficiary or benefit, and that would be 50% of your full retirement age. So let's say you're eligible to 2,000 under disability, and you have two children, they're both eligible to $1,000 each. So another 2,000. That's how that would work. Once they hit age 18 or have graduated from high school, then they would no longer receive that benefit after age 18. And it just until you don't have any beneficiaries that are eligible, they just remain. It doesn't affect the individual that's receiving the disability, which is a nice thing. It's just in addition to.
Thank you. Next up, a question about the county retirement, the county pension. Does that count as income towards Social Security?
So no, it wouldn't count when we're saying those numbers that we use, the 19,000. That is not towards it. So that's passive income. So the only income that's going to count against your Social Security income limits prior to full retirement age is going to be work. So only W-2 if you're actively working out there, or if you have your own business, again, the net income from your own business.
All right, and then here's an easy one. What does the acronym FRA stand for?
Yeah, so full retirement age. So you'll see that in some, at times FRA, or hear someone use that, and that's full retirement age. So that would be that chart that we looked at currently for this year. People born in 1956 is people reaching age 66 in 4 months, and then every year subsequently. So in 57, those born in 57 were tacking on another 2 months, so they'd be at 66 in 6 months, ongoing until we hit 1960 and above. Anyone born 1960 or later is at age 67 currently. Now, if that changes in the future, we'll tackle it as it comes, but this is what currently is in place.
Thank you. And then if you could reiterate, when you're looking at earnings, is it the highest years, the consecutive years, the most recent years? If you could just go over that one more time.
Right. So when we're looking at the 35 years, it's the highest years after we have already done the indexing for inflation. So we're going to take all of your work throughout your lifetime that you've paid into Social Security, we're going to index it for inflation, and then we're going to select the highest 35. And those aren't subsequent. So it's not your past or, in a row. It's wherever it's at. So it may be, 2 years when you're 24 and 25, and then from 30 on for a few years, and then 50 to 60. It's whatever the highest 35 are.
Thank you, sir. And then there was an interesting question that came in. You have a fan here who attended your last webinar. Here it is. So at that time, you said there was an issue with 2020 pandemic economic crash that would affect people born in 1960, that it was possibly going to be addressed. Can you speak to that? Do you know what they're
So
talking
no, so there's no real changes due to COVID. We did have our most current report that came out as far as the trust fund, and as of recent, there was no effect on that on the individuals or change. Um, so as of right now, COVID has not had any type of, I'll say, a negative effect against the trust fund and where we're at with that, meaning the solvency of Social Security um, has remained the same from those reports.
All right, good news. As far as the increased premiums, is that something that continues forever, or do they keep looking back at the prior 2 years and recalculating?
Yeah, good question. So it's always using 2 years previous. So if you're 2022, you stop working and they look at 2020 and they would have that increase, then you get a waiver. In 2023, we're going to look at 2021. And so if that was also the same scenario, you file another waiver, the SSA 44, we decrease it back down for you. Then the following year, hopefully will be at some point, we're going to look at a year where your income is less and it won't be a question anymore. So normally what people will see with the IRMAs, the income related monthly adjustment amount, is usually about a 2 year from when they stop working. Now, there's other things that can affect it, like a sale of a home. That's not a life-changing event. That's to your positive, right? An income, you win the lottery, whatever it may be. So that could push you into a different tier. But then again, it would be for 1 year as that is affected as you file those taxes. And then the next year when we look again, it hopefully would kind of go away for you.
All right, very good. We have a question here about kind of the timeline of earnings records getting posted. Are they posted after the tax filing season? Would we expect to see zero earnings for 2021? How does that work?
Right. So currently 2021 would not be on there until that has closed after April of this year. Once IRS goes through those and pulls that through, they send it to us electronically, which usually happens about June, July at the latest, right in around there somewhere. And then those numbers are posted to the individual's record on Social Security. So it takes a few months, usually by fall of the following year, those numbers are posted. So 2021, sometime mm, early fall of this year, you'll see that number show up.
All right, next question is about becoming disabled after retirement. Would there be an increase to somebody's benefits in that situation?
After retirement. Now, if you're saying in the question, was it they're going to continue working or just after retirement in general?
It sounds to me like they're drawing their Social Security retirement benefit and then they become disabled.
Okay. So if you're already full retirement age or greater, there is no disability. So there's no change. Now, if you are continuing to work and you have a disability that keeps you from working, you could file a disability even if you had already started a retirement benefit. Um, Usually not the case because of the income limits, so generally a person isn't filing if that's the case, but there is. So disability is always prior to full retirement age, and that would be the only income after or difference. But after, again, full retirement age, it's the same because disability pays at full retirement age. So if you've already passed that age, then there's nothing to change there.
Thank you. And I'm going to ask you to again go over, since one person is asking, just in case other people are wondering, can you please explain again why you would not want to retire past 70 years old?
Sure. So the delayed retirement credit that you receive maxes out at age 70. So from whatever your full retirement age, 66 in a few months or 67, whatever that may be, you can get delayed retirement credit up to age 70. Then at 70, we're not going to add any additional percentage or income delayed retirement credit to you. So going past 70 and not taking your benefit is for every month you don't take it, you're missing out on whatever that benefit would be. So everyone definitely, if you're delaying your benefits and you're not going to take them, do work, maybe you continue working or you have sufficient income, you just want it to maximize, then age 70. The month you hit 70, that's when you want to start your benefits.
Thank you. Simple question here. What deductions come out of Social Security when you're receiving the benefits?
Nothing comes out of Social Security unless you ask us to. Now, we cannot take state tax out for you, and it's always volunteer if you want to take out something for federal tax. You would complete a form, a W-4V, and you would let us know what percentage you would like to. There's some standard percentages on that form, and you select which you would like. Normally, most people will talk to their tax individual and say, okay, how should I do this? Or they let the first year go by and determine if it's how it's affecting them and if they need to take a percentage off of for the federal side. But again, we cannot take out for the state.
Thank you. Another simple question here. Does rental income not registered as a business count towards those annual limits?
No, so rental income is what we consider passive. It's an investment, so that would not count as self-employment. So that would not count towards that income limit.
All right. I think that's going to do it for the general questions. We do have a lot of questions that came in that are pretty specific, kind of unique scenarios. So I would ask that you do your research, call Social Security. If you don't get answers from there, reach out to Jeffrey. What time is it? 12:56. So that takes us right up until 1. And I do want to reiterate for everybody, the PowerPoints, the presentation will be available after today. That will be going out. I want to thank Jeffrey for giving the presentation. A lot of really good information, broken down very, very nicely, very digestible. Jeffrey, did you have anything else that you wanted to add before I sign off here?
No, I just appreciate everybody the time to allow me to share with you the information. Again, as was mentioned, just check the website. If you don't get the answers or you're having trouble getting through to one of our offices, you have my email there, jeffrey.rodriguez@ssa.gov. I'm more than happy to help you. That's what my job is here for, my position. And so, send me a question if it's a little more complex or you just really need to speak to someone and having trouble to reach out. Let me help you. I don't want you to be confused. Planning for retirement is so important, and I don't want you to walk in not knowing or feeling like you're getting ripped off. So reach out. And other than that, I hope you have an excellent retirement when you get there, whether it's soon or in the future.
Thanks again, Jeffrey. Hopefully sooner rather than later, right? And to
Yeah.
everybody, again, I just want to give a quick plug. Next Wednesday, we're going to be doing the same thing, a lunch and learn, just going over Medicare. So you should all have that email. And Jeffrey, pleasure. And until next time, bye, everybody.
All right. Bye-bye. Thank you.